And so, how do we actually interpret market sentiment indicators? Because our ability to interpret these signals will go a long way in helping us, in our overall investment decision-making process. That's what this video is all about. So, market sentiment indicators like the VIX, as VIX, help investors gauge the overall mood of the market, offering insight into future volatility and investor emotions. Market participants are wonderful people, That's why we have the idea of Mr. Markets that can quote any kind of price based on his sentiment or emotion or mood at that particular instance. So it's left for you to ignore the market, Mr. Market, or to use his mood to actually benefit from the market. So here is how to interpret the VIX and similar indicators. So we want to see precisely how we can interpret these indicators so as to be able to harness them to produce better investment results. Number one is VIX, Volatility Index. The VIX is referred to as the fear gauge, and measures expected market volatility over the next 30 days based on the S&P 500 options prices, not even based on stock price, based on option prices this time around. So high VIX, that's a VIX value of above 30. When the VIX is above 30, so a high VIX indicates elevated fear and uncertainty in the market. So investors are expecting larger price swings, and often associated with downturns or period of heightened risk. So a VIX above 30 often signals panic or a market correction. So generally, when the VIX is above 30, the market is in a panic mode. Participants are panicky, and they are likely to start panic selling. All right, and then that indicates that the market will eventually is about to correct itself. If it was overvalued at that instant, you will realize that price will start to come down. In the case of low VIX, that's the VIX value are below 20. A low VIX indicates investors' confidence and stability. When the VIX is below 20, the markets are typically calm with lower expectations of volatility. A low VIX often signals a bullish sentiment in the markets. So a lower value of VIX indicates that yes, there's bullish sentiment in the market. Number two is put-call ratios. Put-call ratio. So when it comes to hedging, you either you employ these are put or call options, as the case may be. So the put-call ratio measures the volume of put options relative to call options. Unfortunately, we don't have these practice in the Nigerian stock market. We don't do call options, all those things. We don't have them yet. Our market isn't all that highly developed. Maybe the future we would incorporate this into our markets. So a higher ratio indicates fear, more put options being bought for protections, while a lower ratio suggests optimism, more call options being bought in anticipation of price increases. It all depends on what investors are expecting. They could either buy a put option, or they could buy a call option, depending on the market expectation. So you have high ratio. So high ratio indicates bearish sentiment, signaling potential market decline. When the ratio is low, it indicates bullish sentiment, suggesting investors are more confident. That is it. Number three is what is called the AAII. That's the American Association of Individual Investors. The American Association of Individual Investors. In Nigeria, we have different investor associations, like that. You have a number of them. You have the independent shareholders from Nigeria, like that, and some other ones. So in the US, this particular body, used to carry out a survey, a sentiment survey. So it gauges the mood of retail investors by asking if they are bullish, whether they are bearish, or whether they are neutral on the market for the next 6 months. They carry out a kind of survey to feel the pulse of investor sentiments, which could be bullish, which could be bearish, and which might be neutral, just plain neutral. So in the case where you encounter, extreme bullishness, so in this case, it can indicate more, it can indicate market overconfidence and potential for a pullback. That's there could be a pullback in price later on. So in the case of extreme bearishness, it may signal market pessimism and potential buying opportunities, as market could then be undervalued. In this case, it presents a buying opportunity, indicating that the market is undervalued, and then eventually when prices start to climb, you make money as a result. You make your money when you buy, not necessarily when you sell. If you buy at a sufficiently lower price, and you have a larger upside potential awaiting you when you sell. Number 4 is advanced decline line. Advanced decline line. Please don't forget to subscribe to this channel and like this video. It will do me a ton of good. It will motivate me to keep on bringing you this level of knowledge that will then make you a better, investor. So advanced decline line, or that's the AD lines here. This indicator tracks the number of advancing stocks versus declining stocks, on the markets. How many stocks are advancing, are climbing in price, and how many stocks are declining in price. So you take that that particular advanced decline line. So a rising AD line, indicates market breadth is positive, suggesting strong market sentiments, while a falling AD line indicates negative sentiments and potential weakness. It's very important. Just look at the market generally. How many stocks have climbed? How many stocks have dropped? So the data, gleaned from this particular observation will be, translated into stock market decision process. And number 5 is consumer confidence index. Consumer confidence index. You have the volatility index, or the fear gauge. You also have consumer confidence index. All these indices are very important. We should understand them as retail investors. So the CCI measures consumer optimism about the economy. High confidence suggests positive sentiments leading to potential market growth, while low confidence may signal a decline in economic activity and stock prices. So in summary, interpreting sentiments indicators like the VIX help investors understand market emotions. So a high VIX, points to fear and potential volatility, while a low VIX indicates calm and confidence. Sometimes, sentiment surveys, you may consider, option data and market breadth indicators provides additional insights into the market mood, helping investors navigate market trends. Unfortunately, in the Nigerian market, in my own country market, we don't have all these we don't have these indicators. There's no put call ratios, there's no volatility index, there's no advanced decline line, there's no consumer confidence index, if I'm not mistaken. You discover that it makes our work a bit easier, in the sense that we tend to focus essentially on fundamentals. So we're not getting distracted by overly sentimental market participants. It makes the overall investment process sort of straightforward. Let's come back some and right direct to the points. Just look at fundamentals and that would be sufficient for you to know precisely what to buy, or what not to buy, or what to sell, or what to hold, as the case may be.